What if I told you we are living through the final great asymmetric wealth transfer in our entire lifetimes? Not just one of them, the last one. Because once the global financial infrastructure is fully built, once stable coins are everywhere, once banks have tokenized deposits, and XRP becomes the universal settlement asset, and once AMMs stabilize global liquidity, markets become efficient forever, which changes the dynamics in perpetuity. And in this video, I'm going to talk about where we are, what's coming, and why this is the final window to position yourself before the system locks in efficiency forever. So we know the system's broken. Unless you've been living under a rock, you're aware of how SWIFT operates. There's nostro, vostro accounts, about $27 trillion that's locked up to be able to settle cross-border. And this traps liquidity. And that liquidity earns nothing for the banks. They can't move it. It's got to sit there so that they can settle it. And that's why there's such latency and cost involved with wires and all the things that have happened. Now that we have ISO implemented as of November of 2025, at least we have the messaging layer of that standardized across all this new global banks and other people. That's kind of the precursor to instant settlement. They have to be able to standardize the messaging before, they're able to settle real time. Otherwise, they're going to be reconciling all of that on the back end, very similar to the back end of the stock market, which still moves T+1. But right now, that liquidity is frozen and it pauses a bunch of things. Insurance settlements, it takes longer for mortgage payments, it takes longer for you to get paid. There's a ton of inefficiencies in how money moves today. It doesn't move like water, which is kind of the whole premise of currency. It exists in a way that doesn't move trustless and it's very slow. That's why you're capable of getting asymmetric bets, because of the inefficiencies, because the system is broken, because people are emotional in markets. And on the other side of this stuff, none of that's going to exist. The spreads, the arbitrage, and many of the other ways that people generate significant returns for themselves via investing, that's going to be truncated. It's going to be a regression to the mean. And that's what we're going to break down here for you today. So that all kind of starts with stable coins. In summer of this year in the US, we finally got the Genius Act passed. So we have full regulation on stablecoins here in the US, but stablecoins really aren't even meant for the public. I think that's a misconception that a lot of people have because they have been using USDC or Tether, and both of those are liability. They are assets that are issued by those counterparties. There's counterparty risk. JP Morgan has their coin, which really hasn't come out to the public. It's for inter-bank settlement. And that's what the majority of these stablecoins are going to be used for. It's not intra between them and somebody else. It's inter. So between all of their branches and locations and all of their systems, this is a seamless way on chain that's a siloed, private, permissioned ecosystem where they can settle value real time for themselves, but not between counterparties. And nobody wants to use anybody else's stablecoin. I've tried to come out publicly and talk about this before. I understand why people would just make the assumption that people would use stablecoins to transfer value, because we've already seen it. We've seen about $47 billion this year settled on chain, which is a lot of money. I can get why the average person would say, okay, well, if they want dollars and this party wants dollars and they want to transact and trade something and both sides get the same stablecoin, you don't need an intermediary asset for those. However, these banks aren't going to want the other's stablecoin. Tether doesn't want USDC. They want Tether. JPM doesn't want Bank of America stablecoin. They want their own stablecoin. There needs to be an intermediary DEX that sits between all of these, and that's what we've been talking about for the last year. If you haven't found this content, you're new here, thank you. Appreciate you being new. Please like, subscribe, check out the channel. If you find value in this, share it with somebody else. When it comes to these stablecoins, now that we have a stablecoin regulation here in the US and banks can hold digital assets to pay fees for the gas on these networks, I think you're going to see the proliferation of this, but it's not going to come out to the public in the near future. I think it's going to take at least another 2 or 3 years before this to be adopted for the general public. And I think that that's actually going to go a different direction. I think we're going to get tokenized deposits. If they did, let's say people do decide we don't need an intermediary bridge asset, what would that do? Well, it would just exacerbate the nostro vostro accounts. You would have hundreds of thousands, millions of these deposits held across all of these banks, again, trapping capital because they're going to have to hold their stablecoin with the counterparty to settle. Because again, they don't want that stablecoin. They want their own. You're going to have some intermediary to be able to settle that value. And this is really where XRP shines. It becomes the universal settlement layer between all of the intermediaries, institutions, enterprises, banks, for back-end settlement between their infrastructures. Public, I think, probably ends up on Hyperledger or Hedera. There's a few other very well-known prominent blockchains, L1s, that will work really well for peer-to-peer and merchant services. But as far as back-end settlement, institutional adoption, XRP really kind of takes the cake on that. And you can do your own research. You can look at Solana, you can look at Ethereum, you can look at Matic. There's a bunch of other things out there that I think, again, I've talked about this before, until we get the Clarity Act that states that those tokens are not securities, these banks aren't going to adopt them. And it only takes one announcement by the BIS to come out and say it is XRP, and it's game over. That is the answer. And that's what I think is going to happen. I don't know if that's before or after price appreciation. Maybe it's the cause of price appreciation. We'll just have to see how all that works out. But for the last 13 years, the XRPL has never been down. It's only been paused twice. And it's been vetted by all of these banks in the back end, trialing and testing the network for their internal ecosystems, but also interoperability with the mainnet to be able to settle with counterparties with no counterparty risk, no jurisdictional risk, no liabilities. And it has instant finality in 3 to 5 seconds. And it costs less than a penny to send $1 million. Like, that is their dream for moving money around the world. If they're holding it on their balance sheet, it's not a liability of the other bank like it would be, even if they want to use Ripple stablecoin, which we know, love, ROUSD. They would much rather issue their own stablecoin and take all of those fees off the treasuries that they're going to be holding to be able to back that stablecoin. And that's why I think peer-to-peer probably moves to tokenized deposits, because with the tokenized deposit, it's not a stablecoin and you can still pay the consumer a yield on that account. But stablecoins, once they are adopted at scale, and we know that XRP is going to be the intermediary asset to settle all those, you have no nostro, vostro. You have no pre-funding. You don't have liquidity fragmentation. You don't have the frictions that we have today cross-border, and you have no shortages in the FX market. This is the missing piece of global finance. And when XRP is used at scale, the inefficiencies disappear. And with it, probably a lot of your ability to get wealthy fast goes along with that. We're right here on the precipice of a deflationary collapse. And if you knew that was coming, you would front run that with a lot of inflation, like central banks have over the last 5 years. We've seen a ton of money pumped into markets, and M2 money supply globally spike, huge amounts of debts across, all of these nations. And a lot of people are concerned. They think that we're going to move into a period of hyperinflation and we're all just screwed. But that's not going to be the case. We're on the precipice of, again, a deflationary collapse. You have the culmination of all of these progressive technologies that are going to come together, and the cost of goods are going to drop substantially. That's what should be happening. As technology progresses, things should actually get cheaper. But because we print so much money and there's a mandate of 2% inflation, the Fed keeps up with that. They have to control jobs and all the other piece too. And that's another big piece of what we're going to talk about here in just a minute with UBI. But at the end of the day, this is going to be a huge transition. There's going to be a complete repricing in markets. Stocks, bonds, real estate, derivatives, gold, commodities. It doesn't matter where your money is. I think there's going to be a 50% haircut when we see all of this unwind. And the reason for that is all of the leverage that's built up in the system from the reverse carry trade. If you don't know about that, please go watch my domino theory, where I explain all that in detail about Japan and their interest rates and what's coming when all those treasuries that they're holding flow onto the market. But I digress. So what's coinciding with this is a fourth turning. If you've read that book, talks about, geopolitical and economic transitions that happen over 4 stages. And normally around the 4th stage or the 4th turning, we have a complete shift in global monetary policy. And that's what we sit on the precipice of. And this cyclical pattern that's happened over those 80 to 100 year cycles, it's not going to happen moving forward. We're going to have stability in markets. We're going to talk about that with the AMMs that are on the XRPL as well. So we have demographic collapse, we have consolidation, global commerce at this point, you have debt saturation, you have real rates rising, you have bond market fragmentation and fragility, you've got currency volatility and hyperinflation in certain currencies, and you have slowing global growth because populations are dwindling. We aren't producing as many people as we used to. This is absolutely needed what's about to happen. And all of this stuff's going to break, and they have to have a way to be able to fix it. Credit markets, FX market, repo market, liquidity pools, consumer demand, all of it is about to take a huge hit. But this crash isn't the end. It's the bridge to the new financial architecture, because after the crash, governments are going to need, guess what? Real-time money, real-time settlement, direct economic stimulation, and a unified base ledger that allows everybody to transact without counterparty risk that they can trust. And this is where the digital rails will become mandatory in the very imminent near future. So let's talk about how that's actually going to affect you. So I mentioned UBI. I'm not here to get into the politics around it, okay? You can love it, you can hate it. I'm not here to debate those things. It is going to become a reality because it's going to be a necessity as we shift into this new age of digitization and tokenization. With AI and blockchain, a lot of people are going to be pushed out of the workforce, and they're going to need time to be able to change their skill set and migrate to whatever they're going to be doing on the other side of this transition. And it's going to take 3 to 5 years for the whole economic shift to take place. I don't know that UBI sticks around in perpetuity, but I think it's a good bridge until, we do see the implementation of this technology and everything's able to stand up on its own and people are saturated in the different markets and where they're going to be after this transition. But one of the things it's going to do with UBI is it's going to stabilize demand. If we have huge furloughs and people being laid off because these companies aren't as profitable and they've lost a ton of money in the stock market, they're going to have some way to supplement people's income so that there's not a revolt. At the end of the day, people have worked their entire lives, and to see their retirement evaporate 50% or lose that right before they're about to retire, this also prevents a deflationary spiral. okay? Because you're going to be able to pump money back into the economy. And the way they're going to be able to do this is unique. So with the tokenization and digitization of all of these payments across an entire, really the globe, you can have an AI sit on top of that and see the discrepancies in an economy and incentivize or disincentivize participating in those sectors of the economy with that UBI. But I do think most people will be able to supplement their standard of living. So you'll be able to buy food, pay for your home or rent, other, basic standards that people need will be met. And the reason they'll be able to do that is because of the deflationary pressure of the implementation of these technologies. They'll actually be able to print money in opposition to that to hold price stability. We'll see a regression in prices across the board with this reset. We're also going to see governments shore up their currencies because there will be loss of trust in these fiat currencies that really there kind of is. Everybody knows that. And that's why you see everybody running to gold and Bitcoin and all these other assets that have finite real value. They're real money, whereas fiat dollar, they can just print more of. And people have come to this realization. So they're going to have to be able to stabilize that and reinstill trust into the population. It's also going to offset the huge unemployment, like I talked about. And it's going to also reinforce social cohesion. If you can't buy food, if you can't pay your rent, and we've seen this right now, like this is all part of the fourth turning where people are at odds with one another. There's huge rifts in the poor and the wealthy. I really think that might exist in perpetuity on the other side of this. Those that understand what's happening and capitalize on it will do very, very well. And it will take much longer for people to establish wealth. Not that it's not possible. I think everybody will still have opportunity, but I think because of the truncation of the volatility in markets and the regression to the mean, you're not going to have these wild swings where people are going to get huge, 20% returns in the stock market in 1 year. But you're also not going to have these huge volatile drawdowns where you're going to lose a bunch of money in the stock market in 1 year either. I think it's going to be up to 10, 15% to the upside and maybe less than that on the downside. That's what I'm hopeful for. And that would actually help people be able to plan and invest and make sure that their future is secured. But it is going to take much longer. The asymmetric bets that exist today in Nvidia and all of these other stocks that have seen meteoric rises, and then also even startups, I don't know how that's going to play out there. Business, I don't think will ever change. I think there's always going to be opportunity for people that are creating value in society at scale. If you can scale something that's technological and helps thousands, hundreds of thousands, millions, tens of millions, billions of people, you're going to be compensated very well for that. And I think that those opportunities will still exist. But as far as investments go, I think it's going to be much less volatile and therefore much less lucrative. So back to the UBI. What is that actually going to require? Well, a lot of the things that they're already implementing: digital ID, digital wallets, real-time programmable money, automated taxation, and the global settlement rails. UBI will actually probably be the first consumer-facing benefit of this new system. And again, not here to debate the politics around it, whether you think it's good or bad, but it will help people, especially if they're displaced in their job. This will be a backstop for them to be able to make sure that they're making ends meet and covering their standard expenses until they can get their feet back under them and get into a new job where they can again create value in society. And this also comes alongside with XRP being the institutional backbone of the financial system, the XRPL being used at scale globally. And if you don't believe me, we've already seen Trump even talk about a $2,000 a month stipend to people that make under a certain threshold here in the US. We've already had UBI implemented in other places all over the world. Universal basic income is going to be, I don't know that, it'll last in perpetuity, but I do think it's going to be a stopgap or a bridge for a certain period of time to allow people to make this transition in the financial system that's about to take place. So on the stable coins, the banks aren't willing to rely on Circle or Tether. Tether was just downgraded by the S&P from a 4 to a 5. There's obviously not any transparency around their deposits. Other counterparties aren't going to trust Tether. And they've, got Bo Hines there now at the helm, helping them launch their US stablecoin that's, compliant with the Genius Act. So USDT, I've had bad feelings about it for a long time. I think there's going to be something there that causes problems. And with that counterparty risk, banks are never going to adopt that. USDC does better. ROUSD does, I think, even better than Circle with their audited, treasury for the XRPL and their stablecoin that's issued on there, ROUSD. But there's still, if you're holding that, you're benefiting that counterparty. You're not benefiting yourself, which is what banks want to do. They're going to be issuing tokenized deposits, tokenized money markets. We've already seen the tokenization of treasuries. You're going to see tokenized credit instruments. And across the board, that allows them to have all of this on chain, but be fully regulated, fully insured, compliant, have real-time settlement, and global liquidity. That's why they're going to do it this way. They're going to choose what's in their best interest. And the consumer, again, gets to benefit on tokenized deposits versus stablecoins because in the way that the Genius Act is written, they can't pass the returns off the treasuries to the individuals. They are keeping them for themselves. So tokenized deposits work differently. They can pay you interest on those deposits. And those will be tradable, exchangeable, real-time, 24/7, 365. If you want to swap in and out of your money market, you're good to go. You will have a tokenized representation of that value that you can then leverage or do something else with to be able to participate and gain additional yield or use for payment. It'll be much different than the way that things sit today, where liquidity gets trapped or locked up and there's frictions to be able to take it out of there. There might be fees associated with taking out of there. You won't have that in the future once all this moves on change. JPMs, tokenized deposits, they're not going to settle with HSBC tokens, right? So again, going back to the stable coins, that's not going to work. They're going to need some intermediary bridge mechanism, decentralized exchange, a DEX, if you will, to be able to swap between these institutions real time with zero counterparty risk. Well, guess what? The only way they can really do that, if XRP has enough liquidity in it, would be to go through XRP. The XRP will always route through the least resistance and least cost to be able to settle a transaction. And if there's enough liquidity in XRP, it will choose that over other assets on chain. Now, that's not to say that there couldn't be, other small pools, liquidity pools, where it makes sense to just move through that instead of XRP. There will be some volume that moves that direction on the XRPL. But at scale, if XRP is $1,000, $5,000, $10,000, I should say when XRP is those prices, it's going to choose XRP. That's how it's built. And XRP is meant to operate at $10,000. And you don't have to take my word for that. Arthur Brito, David Schwartz, the creators of that blockchain and that token have stated that multiple times. If you want to go check it out, all you got to do is Google it. So what else is going to be tokenized? It's a foregone conclusion for me that all this is going to take place. We're going to have the reverse carry trade unwind, and we're going to see the implementation of the XRPL and XRP as the backbone for global financial markets. And on top of that, you're going to have tokenized treasuries, money markets, equities or stocks, real estate, mortgages, corporate credit, royalties through NFTs or non-fungible tokens. There's going to be infrastructure revenue aside from those things as well. So what is that going to provide? Well, there's going to be 24/7, 365 liquidity for all this stuff. Instant settlement, fractional access. So, instead of having to buy a whole stock of Berkshire Hathaway and you need $500,000 to do it, you'll be able to buy 1,000 or 1/10 of a thousandth of a share in these corporations, which makes it much more accessible. And they're not going to have to do stock splits, which is going to be fantastic for the market. And then you'll have real-time consolidation on the back end of all this stuff. They'll be able to reconcile it and settle it instantly. So you won't have gaps in markets or halts of trading, which, we had one on the CME just the other day because the servers were overheated and silver was skyrocketing. There's going to be a lot more transparency that goes along with this stuff also when it's on chain. And you'll have a global distribution. People will be able to access markets from anywhere right from their smartphone, which is what everybody wants. That's why they're building this, because they can see the adoption curve of the mobile device. And we're right on the precipice of people being able to access and democratize access to all of this stuff real time right through apps on your phone. So for the first time ever, capital markets become an internet on their own. So for that to happen though, what actually needs to take place? How do markets become their own internet? Well, you need automated market makers, and there's lots of chains with AMMs. I like the XRPL's AMM because of the way that it works. When you participate in a liquidity pool or an AMM on the XRPL, you're issued LP tokens that represent your interest in that pool. If you one-side it, you can have some losses. There's always going to be price bids that go to that market, and they're going to be consolidated. You're going to need a real-time price oracle. Flare has done a fantastic job of this, of incentivizing people to provide good data, and they're going to have the pricing the right way. So the arbitrage and the spread on this is going to be much smaller than what it is today. So an example of this is exactly how Sam Bankman-Fried made his money early on. So I know nobody likes Sam because of FTX and all that, but he's actually a pretty sharp guy. So when he first started out, he was arbitraging Bitcoin. What he would do is he would buy Bitcoin on one exchange where it was cheaper than the other exchanges. He would then send it to another exchange where it was more expensive, and then he would then sell it. What an AMM does is it consolidates all of that pricing to one actual price across all markets. Now, there's still going to be some arbitrage and trade where the order books on this exchange and that exchange are a little bit different, and it's going to be able to route those discrepancies, and there will be people that arbitrage that. And for people to arbitrage that in the AMMs on the XRPL, they have to bid for that opportunity. So they won't have fees for their trading for the 24 hours that they bid for. And based on my conversation with David Schwartz, he thinks they're going to be bidding somewhere between 90 and 98% of the value they think they could make over that 24-hour period. And those LP tokens go back into the pool, they get burnt, and then the people that are providing liquidity to the pool actually make money. Their asset, their LP token, goes up in value because of supply and demand. There's less of the supply, same amount of demand, the price of the token will appreciate. So it incentivizes people to provide liquidity to these AMMs, and this does a lot of things. So it's going to remove the fear and greed in the market. There's always going to be human emotions when trading, but the market makers will be taking that liquidity and they'll be modulating the trading in the market. It'll also unwind the leverage that people take, and there'll be algorithmic cascades that make sure there's price stability for things instead of wild swings. And you're going to have constant liquidity. So right now you see gaps in order books, right? So we saw this on Kraken the other day. There was a trade for XRP at $91. There was a huge gap in the order book, but there was somebody there that was looking to sell and somebody looking to buy at that price. With an AMM, you're not going to have that. They are going to take the other side of the trade if there's nobody there to take it in the order book. So this provides constant liquidity. It compresses the spreads to nearly zero. You have auto rebalancing, and it's going to force a regression to the mean while maintaining, some ability to arbitrage, but that'll be instant also. And it eliminates liquidity blackouts where there's not anybody to fill that order. And this is awesome for illiquid markets that are going to be moved on chain in the future. Right now, stocks are extremely liquid, treasuries are extremely liquid. A lot of these things that are currently being tokenized, funny enough, are the most liquid markets. But on the other side of the implementation of this, as we progress down this path over the next 5 years, you're going to see all of these other asset classes that I just mentioned before, real estate, private equity, private credit, all of that will move on chain too, and it'll provide people liquidity that are holding those assets that they didn't have before. This is also going to remove a lot of the flash crashes that we've seen. There won't be any more multi-year bubbles that form, and no more liquidity-driven collapses or panic spirals. There's going to be, somebody that steps in basically as a price floor or a ceiling on stuff and keeps the crazy volatility from taking place. And that's why I think right now is your best opportunity of your lifetime to capitalize on what's going to be the largest wealth transfer that we've ever seen in history. And on the other side of it, it's going to be a slow, steady accumulation of stuff. Not that you can't make money investing, but I think it will be much slower. And the asymmetric bets that exist today will be a far gone idea from the past. It won't be as prevalent as it is right now, especially in markets today. And what's that going to look like? Well, it's going to be smooth, it'll be stable, it'll be predictable, and it'll be fundamentals driven, which is really kind of goes back to Warren Buffett and Ben Graham. Like, they looked at values investing. They wanted to buy a stock that was fair price or slightly underpriced from what they thought it was actually worth. Today, PE ratios are at 23, 24, 25, the highest that they've ever been in history. And that is a bubble. That's going to collapse. These valuations on these corporations have to come down, and the leverage is going to get sucked out of the system. And when it does, it's going to be a bad day for a lot of people. And this is why asymmetric return opportunities are going to just basically disappear outside of investing in startups in the future. None of this is financial advice. It's only for entertainment, educational purposes only. If you need financial advice, please speak with a financial advisor. If you need a financial advisor and you're in crypto and you want somebody to actually help you with that, you can reach out to digitalwealthpartners.net, and one of our advisors there would love to help you. Back to the intrinsic value of the markets. Warren Buffett, Ben Graham, they're looking at cash flow. They're looking at margins of safety. They're looking at durable competitive advantages or moats around corporations. And those are going to be circumvented and disintermediated by new technologies much faster than they have been in the past. So unless you have, a patent on some IP, and even if you have a patent on some IP, there may be something else that comes to market that completely eradicates what you've done. A good example would be Blockbuster. Okay. I'm sure maybe, if you're my age or a little bit older, you have nostalgia for that. You went to the movie store and you got a movie and you took it home, maybe got some candy at the counter, which I loved. What do we do now? You just turn your TV on and get on Netflix or Hulu or one of these other streaming services. You don't have to go to the video store. Blockbuster had a chance to buy Netflix and they didn't do it for $50 million. They wanted to add more candy to the checkout line. They were disintermediated. They actually finally had their first and last store shut down last year. That was a 30-year saga. These new sagas for corporations are going to have meteoric rises and meteoric falls. With the advancements in AI and quantum computing and distributed ledger technology and all of these things culminating, you're going to see an exponential move in how fast things change and how fast companies arise and do well and then completely get eradicated. It'll be, a 3 to 10 year cycle instead of, what we've seen in the past, a 20 to 50 year cycle for a lot of corporations that were on the S&P 500. And in that, there's going to be some opportunities still, but a lot of that's going to be truncated again because of these efficiencies that are going to be in markets. So how are people actually going to invest in the future? Well, they're probably going to be diversified. They're going to be arbitraging different financial products. So with tokenized treasuries and the money markets and the liquidity pools for the AMMs, you're going to have tokenized credit markets. You're going to have real world yield streams that you're able to participate in or, create for yourself itself. I think that streaming services will have, real-time payments for the consumption of that content. And then you're going to have people that aggregate yield. There may even be new like private equity funds that buy up streaming services or other things that aggregate that in one fund or financial product that streams you payments off of the backside of that. That sounds like some wonderful passive income. But again, you're going to have the liquidity and the money to be able to invest in those. And if you don't own some of these digital assets, I don't know, what people's economics are going to look like if they're not participating in this wealth transfer. There's going to be a disparity between the people that did and the people that didn't. But I do think the standard of living for everybody is going to come up. So, people won't feel as poor. They will have opportunity, and there still will be, again, these markets that they can participate in and plan their future without all the volatility that we've seen in the past. This infrastructure also creates ownership that you didn't have in the past. You're going to be holding bearer assets if you're holding on to crypto, but you could also be holding the tokenized representation of a lot of these things. With that, those that are holding the bearer asset, I think are going to have a significant advantage over those that are participating in derivatives like ETFs or some of these other financial products that we've seen bring to market or be brought to market by the banks. And this has been the plan the whole time. I've talked about this in another video. They have not created segregated accounts inside the infrastructure at these banks to be able to service retail holding digital assets. They're aggregating them. They're using omnibus accounts, and that's how the infrastructure for Fireblocks and Copper and a lot of the other infrastructures I've seen are built. They're built for one massive account, and then they use that liquidity in whatever means they need to, but not for consumers. They haven't really structured things out with sub-accounts the way that we do at Digital Wealth Partners to make sure that you maintain ownership of those assets while still being able to participate in institutional products. So with the arbitraging of all of these financial products, you're probably going to see algorithms come out, and AI is going to play a big role here. Either hedge funds or institutions are going to keep those proprietary, and you're going to have to participate with them as the intermediary, or there could be a distribution of access to this stuff across markets at scale for retail, where you're able to participate in these strategies. We've already started to see some of those people like Arch Public, put this out on the exchanges where people can participate in their algorithmic trading strategies, and they're able to generate compounding returns on their assets that they're trying to aggregate and or cash flow. So democratization of access to these algorithmic trading strategies, I do think will be more prevalent, but they're not going to come without costs and fees. And maybe there's an opportunity there for somebody. If you are a quant or a mathematician and you can build out algorithms to arbitrage or trade between all of these financial products real time because they're on chain and liquid, you're going to do very, very well. But there's not going to be the chaos. We're not going to have these big macro cycles. The fear and greed index is probably going to sit a lot closer to the center most of the time. And we're not going to have a broken market structure that causes delays or frictions where people are able to rake fees or make big gains because of the inefficiencies in the system. So just know that. There's not going to be these 100x moonshots anymore, but there will be stable, compounding, real returns as GDP continues to increase with these innovations that are brought into the economy at scale from these new technologies. So for those that still might be asking themselves, well, a once in a lifetime thing, look, I'm in my 30s. I don't have a lifetime worth of experience, but I cannot impress upon you where we're at in history right now. My honest answer, if you asked me, will there ever be another opportunity like this, is no, not like this, not at this scale, and not with this amount of asymmetry. And the reason for that is liquidity is not going to be fragmented. Volatility won't explode one direction or the other. The arbitrage that we see today won't be as robust as it is. It's going to be far less because volatility in markets alongside, pricing mechanisms will be much more consistent. You're not going to have bubbles that inflate like this because of M2 money supply and interest rates manipulation and all the other things that we've seen from the central banks. And the information being shared also won't be asymmetric. And I feel crazy sometimes, looking at this. I see things that other people don't. And that's when you're able to bet against the market and be right, that's an asymmetric bet. You don't have to risk much capital, and there's a lot of upside. And so that's the conversation I have with most family offices at this point is, a 1 to 5% allocation to crypto is plenty, especially if you want to maintain your portfolio value in the event of, a 50% haircut across the rest of your investments. And it's really a hedge if you're invested in the right digital assets at this point. And aside from that, in the future, markets aren't going to break. They'll be efficient, they'll be automated, they'll be transparent, they'll be stable, and they'll be machine regulated. And once this happens, the age of giant asymmetric bets, outside of, again, getting in early on a startup, is probably gone for the rest of your life. So if you're still with me, we are living through the greatest asymmetric wealth transfer of our lifetimes. Not one of the last, the last. Because once XRP eliminates nostro, vostro, once stablecoins and tokenized deposits are fully adopted, once every treasury, mortgage, stock, bond, money market, and credit instrument are tokenized, and once AMMs eliminate volatility and collapse spreads, the age of chaotic asymmetric opportunities, it ends forever. We're no longer going to see global liquidity erratically placed. It'll be balanced by algorithms instead of human emotions. The new system's going to be efficient, stable, transparent, automated, and it's just not going to have the volatility that we see today where people are able to get these 100x on, meme coins or stocks or basically anything else out there. You will, again, still have the opportunity to grow your wealth steadily over time, but if you're not participating in this, you're not ever going to see anything like this again, even in your kids' lifetimes, in my opinion. So never again are we going to have, chaos-driven wealth events. They always say never let a good crisis go to waste. I don't know that we're going to have a whole lot of crises. It's not that we're going to move into a utopia. There's not a utopia or dystopia. I think it's somewhere in the middle. And there still will be, global macroeconomic events that take place. But I think as the world becomes galvanized and globalized through these systems, a lot of those frictions and conflicts are going to be resolved. And with the dissemination of information across social media, everybody's going to have access to all the same stuff. So it's going to be very difficult to get an edge on other people or see something that's coming before others. So in this moment, before the world locks into efficiency, before machines take over the liquidity, and before the new financial architecture hardens into place, this is your last window. And after it closes, I don't think it's ever going to open again. So let me know what you think in the comments below. Am I crazy? Is there always going to be volatility in markets? It's not going to matter with these efficiencies between distributed ledger technology and AI and all the stuff I just talked about. Do you think all of that's just not going to happen? Which I think is crazy at this point. There's too much evidence that it is. What about UBI? Are you in agreement with that? Do you disagree with it? Do you think it's crazy? Are you excited about it? I want to know. Let me know in the comments below about all those things. If you did find value in this, please like, subscribe. We'll see you guys on the next one.